Friday, May 20th, 2022, Monaco 64, home of alternative economics and contrarian views. So China just cut mortgage rates as the world economy starts to keel over again. We're going to look at some of the data that have come out as well for the US, for the UK, and even for Germany. They're all looking, in my opinion, very stagflationary. And I think the mainstream media, mainstream economists are still asleep about stagflation. They think inflation is going to come down nicely as the world economy slows down. But I don't think it's going to be as simple as that. Of course, we're going to look at where the markets are this morning as well, after we look at China, the US data, and the UK data. And as for the stagflation, I think it's a sign of currency depreciation, currency debasement, and the dollar, of course, is at the heart of this. And the dollar can only really devalue against real things, real goods, gold and silver. And we're going to look at that as well, how commodities are starting to move up again, and even gold and silver, I would say. So yesterday we had some US data. We'll start with the US data and then we'll come to China. So we had jobless claims, initial jobless claims. They come out every Thursday, of course. They're not the non-farm payroll number that comes out in the first Friday of the month. But jobless claims had been very low, historically below 200,000. It was expected to jump from 197,000 to 200, but it jumped to 218,000. And that's a really big jump there. And I think it's one of the reasons why we saw the bond market go up yesterday. Treasury yields went down. The 10-year yield went down. I just saw a headline that in hedge funds and Wall Street is seeing bonds as a safe haven again. But I personally think they're wrong. The 10-year yield started the year at 1.5. We're still almost at 3%. How can you say that that's a safe haven? Yes, I think maybe bonds could rally in the short term and yields drop, but the medium to long term direction for yields is a lot higher. And that's one of the reasons why we're going to continue to see slow growth, higher prices, stagflation, right? We had another number, the Philly Fed, which is closely looked at, Philly Fed Manufacturing Index. That made a huge move down from 17.6 the previous month to 2.6 in May. And it was expected at 16. And this is a closely followed number by the markets. So that's, I think, another reason why the market's starting to pare back expectations of rate hikes by the Fed. There's a Eurodollar futures contract that I use to trade a lot for my clients. It's one of the biggest interest rate contracts. It's the 3-month, it's based on the 3-month LIBOR rate. The Eurodollar futures is traded on the CME. And basically, it kind of tracks the Fed funds rate. It's not exactly the same, but if you look at the December 2022 Eurodollar future, it's trading at 96.84.5, which means that they expect the 3-month LIBOR in December to be around 3.15%. You just take 100 and you subtract the price. That's how you get it. But the interesting thing about this is if you look at the December 2023, which is where they expect the 3-month LIBOR rate to be at the end of next year, that contract is trading at 96.86 and a half. So it's discounting a lower rate at the end of next year than at the end of this year. So that means the market is not expecting anything else from the Fed after 2022. And I think it's important to keep an eye on these euro-dollar futures, because I think the prices for September this year and even December this year could start moving up as the market and speculators, investors rein in their expectations of rate hikes. So this is another signal here. We've also had some economic data from the UK, which are pointing to a really bad slowdown in the economy here, which I think is going to happen everywhere. It's happening in China, it's happening here, it's going to happen in the EU, and it's coming to the US as well. So this came out late yesterday. UK consumer confidence falls to record low. So there you go. It says here, UK consumer confidence has dropped to its lowest level for nearly 50 years, amid the cost of living crisis, according to a survey, fueling concerns that the economy will slide into recession in 2022. So the pivot is coming for central banks, and we're seeing that coming from China. And we continue with the UK, and then we'll look at Germany. Retail sales this morning in the UK came out at 1.4%. They came out a bit stronger. They were expected to drop by 0.2, but year on year, they're still down about 5%. German PPI, the producer price index, came out at 33.5%. It rose from 30.9, and it was expected at 31.5. So there's the stagflation part there, or the inflation part. It's not going to get better. So to China now. So here's the story. China cuts mortgage lending rates by record as lockdowns hit economy. 5-year loan prime rate slashed by most since before pandemic as government steps up stimulus. China has cut its main interest rate underpinning mortgage lending by the most on record as policymakers seek to mitigate the economic impact of severe anti-coronavirus restrictions and the property sector slowdown. Well, remember Evergrande late last year, beginning of this year, it's really hurting the Chinese economy. And despite that, commodities, as we'll see in a minute, are still really strong. So can you imagine when China starts really stimulating, really picking up on its rate cuts and everything else? And when the Fed starts pivoting, I think, commodities are going to fly. It says the 5-year loan prime rate was lowered from 4.6 to 4.45% on Friday. The reduction in the rate, which is set by a committee of banks and published by the People's Bank of China, will directly reduce the borrowing costs on outstanding mortgages across the country. A cut was widely anticipated following data this week showing worsening economic conditions across the country, but the 15 basis point reduction exceeded analysts' expectations and was the most since the country's rate system was reformed in 2019. And this is what a Citibank analyst said. The move marks the strongest signal and action to support the property sector in recent years. And another interesting thing is that President Xi Jinping, who's bidding for an unprecedented third term in power later this year, he's gonna want to make sure that the economy is doing well if he wants to extend his grip on power. So now quickly to the commodities. I was looking at this chart yesterday of the Invesco Bloomberg Commodity ETF, and you can see how we topped in the beginning of March, just after the war in the Ukraine started, and we've been going really sideways now, but I think we're ready to break out again. I looked at the commodities as well yesterday, the different sectors, and the sectors that have lagged really of late have been the precious metals and the base metals or industrial metals. And I think they're starting to look like they're bottoming. All the other commodities, especially the grains and the softs, they're still looking really bullish. They're all near like recent highs. And yes, this is a symptom of a weakening currency system. The dollar, as I've said, can only really be devalued or debased versus real things because it's the reserve currency. So just wanted to show you a little more of this chart of the Invesco Bloomberg Commodity Index. And as you can see, though, it's up 30% year to date. So much for treasuries and bonds being a safe haven against the stock market going down. So if you look at the 5-year picture here, we really started breaking out. If you look here, back in April 2021, this isn't because of the war in the Ukraine. This is a monetary phenomenon. The war in the Ukraine, if you look at February 25th, is only helped commodities a tad. But I think we're ready to break out again. And now we go into the markets and to gold and silver especially. I thought the move yesterday was very interesting. I noticed it early in the day, London time, while stocks were getting hit hard. Gold and silver suddenly caught a bid, and I thought that was strange, and it continued to go up higher throughout the day. So I think gold and silver are pointing to more and more stimulus, and I think they could outperform the general commodities quite a bit because they've been really in consolidation for 2 years. Yes, they did forecast the inflation that we've had when they went up from March 2020 to the summer of 2020. I mean, silver went from below 12 to 30. Gold went from 1450 to almost 2100. And I think now they've just been kind of consolidating and resting and waiting for commodities to catch up with them. But I think we're going to go on a next move higher. And yes, keep an eye on the data. I think Jay Powell in his last press conference kept talking about policy being data dependent. And we're seeing a lot of headlines from Wall Street, like people like JP Morgan, Goldman Sachs, talking about a coming recession. So it's only a matter of time. And we saw that Congress passed that $40 billion bill. I mean, that's tiny compared to the stimulus we had in 2020. But I think they're going to find an excuse for more, not just monetary stimulus, but fiscal stimulus. It's coming, and it's going to come here in the UK as well. I've noticed they're talking about some other kind of monkey virus. I think they're trying to set us up for more crises, unfortunately. But we need to keep our eyes on the ball, on the commodity, hard asset ball. That's the place to be. Recession's coming. Yeah, I don't see any other solution for governments and central banks unless they want riots and revolution, if they allow the system to implode. It will implode eventually, but I think it will be the crack up boom implosion in terms of the collapse, deflationary collapse and implosion. So let's quickly look at where the markets are this morning then. It's 8:22 a.m. London time. We got spot gold up $5 at 1847. The high's been just below 1850 and the low 1836. Silver is up 10 cents, trading at 22.01. It's been up to 22.09 and the low has been 21.79. The Dow future is up 200 points. NASDAQ future is up 140. S&P 500 is up 33 points. So the stock market rebounding a little bit here overnight. It's still early days though. The FTSE 100 index is up 100 points or 1.5% at 74.01. And the Euro Stoxx is up 26 at 36.67. To the currencies. Sterling is unchanged, 124.68. The euro is down slightly at 105.67. The dollar is up an eighth versus the yen, 127.95. The dollar is unchanged versus the Swiss franc, 97.29. The dollar is down 0.2% versus the yuan at 6.68. Let's check out the Russian ruble today before we go on to the Aussie. The ruble really strong here and the dollar very weak. We're trading at around 60 and a half. So we're right near the lows here, multi-year lows for the dollar versus the ruble. Aussie dollar, where are we? Unchanged, 70.44. The dollar is down 0.15% versus the Canadian dollar, 128.04. And the Kiwi dollar is up 0.25% at 64 versus the dollar. General commodities, WTI crude is down 0.8%, 108.85. Brent is down 2/3%, 109.77. And high-grade copper is up 0.25% at 4.29. And U.S. nat gas down 2 3/4%, still at a relatively high level of 8.12. To finish off, the 10-year yield is up just over 1 basis point at 2.87. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great weekend. Take care. Bye.